How do property taxes and insurance factor into mortgage payments? If you're planning to buy a home, you might be wondering how property taxes and insurance fit into your mortgage payments. Let's break it down to help you understand what you're getting into. When you take out a mortgage, your monthly payment isn't just about the loan itself. It also includes other important costs. These costs are often managed through an escrow account set up by your lender. First, let's talk about the principal and interest. The principal is the amount you borrowed to buy the house, and the interest is what you pay to the lender for lending you that money. But that's not all. Your monthly payment also typically includes property taxes and homeowners insurance. Property taxes are collected by local governments to fund community services like schools, police, and infrastructure. These taxes can vary significantly depending on where you live and the value of your property. If you use an escrow account, your lender will collect a portion of your annual property taxes each month and pay them on your behalf when they're due. Homeowners insurance is another crucial part of your mortgage payment. This insurance protects your property and assets against damage or loss due to events like fires, theft, or natural disasters. Like property taxes, homeowners insurance premiums are usually included in your monthly mortgage payment and managed through the escrow account. Now, let's discuss how escrow accounts work. When you apply for a mortgage, your lender will estimate your monthly payment, including the principal, interest, property taxes, and homeowners insurance. This estimate is based on typical costs in the area where you're buying. However, the actual amounts for taxes and insurance won't be finalized until you choose your home and insurance policy. Using an escrow account can be very convenient. It means you have fewer bills to manage, as your lender handles the payments for property taxes and homeowners insurance. This setup also helps with budgeting by spreading the cost of these expenses over the year instead of paying large sums all at once. However, there are some potential downsides. If property taxes increase, your monthly mortgage payment will also go up to cover the new tax amount. This can make budgeting a bit more challenging. Additionally, some people prefer to handle these payments directly to have more control over their finances. If you choose not to use an escrow account, you'll need to make property tax payments directly to your local tax authority. This requires careful budgeting to ensure you have the full amount ready when the bill is due. Missing these payments can lead to penalties or even a lien on your property. In some cases, you might also have to pay mortgage insurance, especially if you put down less than 20% as a down payment. This insurance protects the lender in case you can't make your mortgage payments. Once you've paid off your mortgage, you're still responsible for paying property taxes directly to your local tax authority. It's a good idea to set aside funds each month to cover these taxes, essentially creating your own escrow account. Understanding how property taxes and insurance factor into your mortgage payments can help you plan and budget more effectively. Whether you use an escrow account or manage these payments yourself, being aware of these costs will make the process of homeownership much smoother.